Welcome, friends. Nowadays, market is too much volatile, and lots of people wanted their capital protection, but they are also charmed with the equity appreciation. Then, what to do? Is there any way out? What they can do is, of course, there is a solution for this dilemma. Market have one product for such a special situation, a special condition where your capital will be protected. Same time, you can expect return like equities. This product is known as equity linked debentures, which have combination of both features. So equity linked debentures are structured fixed income products that combine the benefits of capital protection along with participation in returns from equity markets. So here two component is. First component is capital protection and second component is participation in equity. Participation in, more specifically, participation in returns from equity market. So how this is structured, how this is possible, let us dissect this. A portion of amount invested is kept aside and that amount is invested in such bonds, such debt equipment, debt instruments, which will appreciate and by the end of maturity period, it will give the equivalent return of a invested amount. Say, if a 10,000 is invested, a portion of that, maybe 2,500 or something, will be invested separately. That will appreciate and give return equivalent to 10,000. In this way, capital is protected. So, first requirement, capital protection is done here. Now, the second part, maybe 7,500 or maybe something, it is predefined at the time of investment. So, this amount is invested not in direct equity but derivatives like call options. And from there, income is generated and those income is shared with investor. Is where the person who or a agency which issues the product, thus ELD, is shared with investor. So how it works? Say participation ratio is 75% and the return is 12%. So the investor will get 9% of return. Let us deep dive and understand it in more better way. At the time of investment, say the index value is 11,500. Actually, it is taken as average of 3 months. So Suppose 11,500. Next month it is 12,000, and thereafter it is 12,500. So average of 3, 11,500 plus 12,000 plus 12,500 will be 12,000. So this will be average of investment period. Now, after certain period, say at the time of maturity, maybe this 34th month, 35th and 36th month, or maybe different, whatever predefined. That time index value is say 17,000, 17,500 and 18,000. These are nominal values simply taken for calculation purposes. Actual value, actual this will be definitely different. So average of 3, 17,000 plus 17,500 and 18,000 will be 17,500. Now, how much will be the return? Return will be average during maturity period, that is 17,500 minus average during investment 12,000. So it will be 5,500. So how much will be the return of the index? 5,500 divided by 12,000 into 100. It will be 45,000, 45.83%. This is index return. But how much will be the investor return? Because their participation is 75%. So 45.83 into 75%. So it will be 34.37%. So the investor will get return of 34.37% from their derivative side or equity side investment. It may be linked with index like Nifty, or maybe a set of equity or basket of equity funds. It depends. But all these are predefined, and during the investment period, you will get the complete detail. What will be the underlying equities, whether index or basket of equities or set of equities. One thing. Second thing, participation ratio to equities. Again, you may ask, what is participation? Participation ratio is percentage, defined percentage, which will be invested in derivative, equity derivatives. So that portion is known as participation ratio. From this calculation, you would clearly understood how capital is protected and how we can expect return like equities. Second thing to note that there is no premature exits. Whatever defined period, maybe 3 year, 4 year, whatever the year, you have to be continue and be invested. There, then only you can expect a return, full return. Of course, ELDs or equity linked debentures are listed on stock exchanges, but these are very illiquid in nature. So there is very less chance of any sale or transfer or of your ELDs. Of course, there is chances of issuers may buy back, but of course there will be some cut from your investment. So you must be aware of this cut. So people who are afraid of risk, associated risk, they may go with ELDs, equity linked debentures. Here, one thing to be noted, it is more riskier than fixed maturity plans, FMPs, but less, less risky than equities. And same way, returns can be expected better than FMPs or fixed maturity plans, but less than equities. So you will get in between returns also. So these are the benefits, or we can say limitations of ELDs. Of course, if you want to invest in ELDs, if you have your financial advisor, you must consult them before investing in ELDs or equity linked debentures. Thank you. If you find some value, please do like and share with your colleagues and friends so that they can also get benefit out of this series. And if not subscribed so far, please subscribe to this channel. Thank you. Bye bye.